In this video, we're going to talk about Clover Health, trading under the ticker symbol CLOV. Clover Health is a healthcare insurer, focusing but not limited to Medicare coverage. The company focuses on providing affordable solutions to those in need and uses the internet as a promotion tool to optimize their cost structure. Its operations are headquartered in Nashville and has presence on both East and Western American coasts, as well as an office in Hong Kong. Clover wants to change the medical insurance landscape, and it uses the internet as a leverage tool to allow the company to reach this kind of coverage. Clover is one of the fastest growing insurance networks in 2020 and 2021, claiming that its membership grew by at least 20% per year. It has a flexible and growing broker community, allowing Clover to see its products reaching even more markets. For the clients, the main appeal of Clover is the low cost and wide coverage. For market participants and potential investors, Clover represents a potential actor in changing and improving the current insurance landscape with better scaling capacity and more optimized cost structure, which may lead to better profitability in the long term. The trading volume of Clover Health has recently been 13.8 million shares, compared to an average volume of 12.4 million shares. Over the previous 52-week period, its price fluctuated between $2.92 and $28.85. The market cap of Clover Health is currently at $1.5 billion, compared to an enterprise value of $3.1 billion. The difference between the market cap and its enterprise value is the premium or discount financial market is willing to allocate to the company based on the current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage includes if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which then may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of them, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a good management, stronger brand recognition, and bigger following online. In other words, it may not be a tangible asset that companies can use to generate more profit, but it's often the reason why companies are perceived to be trading at a discount compared to their market cap. Because the market cap is lower than the enterprise value, since the enterprise value includes the value of the goodwill. In comparison to its historical price fluctuations, the stock is 6.3% higher than the 1-month low, 6.3% higher than the 90 days low, and 6.3% higher than the 1-year low. In terms of the options market, which often gives a hint on the market sentiment where the stock is likely going to head toward, the implied volatility is 100.3% compared to an average of 68.9%. The put-call volume ratio is currently at 0.28. The most recent volume of options traded has been 28.5 thousand contracts within a day, compared to the 30-day average volume of 30.5 thousand. In terms of open interest, the most recent volume of open interest has been 414,000 contracts, compared to a 30-day average of 436,000 contracts. In terms of its shareholder structure, institutional shareholders hold 22.8% of its outstanding shares. The biggest shareholders include Vanguard, PNC Financial Services, and Green Oaks Capital. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to simply trade it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit should the share price fall lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 6.3% of the total float and 58.1% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements that determine what should be our overall approach. Oscillators are showing 0 sell, 6 neutral, and 5 buys, with an overall tendency of buy. The moving averages of the past price action has 13 sell, 1 neutral, and 1 buy. The overall tendency from the perspective of the moving average is strong sell. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $1.46 and $3.63. For the resistance levels, they are $3.84, $4.97, and $5.48. Looking at Clover Health, I would say that the fundamentals aside, the current sequence of events is challenging for the shareholders, although it may not necessarily be caused by the company's own fundamentals. Market participants, and more specifically retail participants, are attracted by the company because it is a stock massively owned by the retail traders expecting Clover Health to go up, which it did for a period of time before going to the other direction. This is a sign that a company is perceived differently from institutional and retail perspectives, and that its volatility would be larger than other more established titles. It doesn't mean that the company is not worth your money, but going in, you would have to understand the risks involved with your capital getting depreciated, which is a result of supply and demand, especially the short volume in the dark pool. My opinion on the company remains overall worthy of your time, and that it deserves to remain on your watch list and eventually in your portfolio if you're future-oriented. With that being said, I would recommend not going in now because the support levels haven't been found yet, and there are not that many support lines either from where it is right now. This is why the exact entry points, timing, and amount should depend on where the stock may be at that time. Something to note is that its price pattern is very similar to the recent price action of many other growth stocks. And this is why I believe that it's a market-wide phenomenon, not necessarily something that is related to the company per se. In terms of its price action, the downward trend is still ongoing, and I believe that it should continue for some time as we move in 2022. So definitely, it's something to keep in mind. This may be explained by the fact that investors have been looking elsewhere from the popular stocks back in 2020, such as the short squeeze stocks. My recommendation is to make sure that your exposure in Clover stock remains at a maximum of 0.5 to 1% of your portfolio, but to keep an eye out for any potential supports found inside. As we mentioned before, right now it would be recommended to follow up on the stock for a good entry point, which may only happen within the next weeks or at the shortest a couple of days from now. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.